Thank you for coming. I guess I can maybe start with telling you a bit about how it will work or what you can expect. Then we will have, it will take maybe about half an hour. We will start with introductions. And then I will be moderating this panel. Who has been here before? Okay. So we are 22minds is a community of startups and entrepreneurs and investors. We are the biggest English-speaking community in Prague because we are the only English-speaking community, unless you know some other community. And we also strive towards bringing community feeling, which is why we are bringing investors and advisors and founders together. And we started to help advisors to invest their time inside startups. So we might hear about that more later about that. I guess what we can do, if you like, is for you to say something about yourself, because it will help us to provide more value and orient our panel discussion towards your needs. The topic is what differentiates successful startups from failing startups and successful teams from failing teams. We have today Piotr Kovaček, I hope I pronounced it right, from Budetto. He has a successful exit, and from that he invested a big sum of money in a startup that didn't work well, and now he is investing or co-founding startups with other people, maybe you, if you convince him. We have Piotr. Piotr, it was I'm very glad that you are hosting us today. Thank you so much. Piotr is now 13 years co-founder or founder, I'm not sure. Co-founder of Direct People. Direct People is a very successful innovation agency. They have 300 customers and a lot of successful projects. I'm not sure how many failed projects. We might hear later something.
Who gave you that number?
I looked it up. Yeah. I'm not sure if it's true. Okay, so.
No, actually, my colleague using AI calculated amount of projects on our project disk, and he calculated 630 during the 13 years. So.
Okay. You need to update your websites.
Some small ones also.
Yeah. So. And then we have Raman Čmelik, managing partner of Limrock Fund. And before, I understand that, I'm not sure if it's an exit or not.
I can speak for myself. Dobrý večer, hello. So yes, I'm co-founder of Limrock. We were managing two venture capital or two funds. Some of them had some venture capital characteristics. One was called Jeremy. The other is called Zero Gravity Capital out of Bratislava. Now we are currently raising the third fund. And what Slava was alluding to, yes, it's a portfolio company that I sit on board, Runcast, out in Brno, which is one of two or three unexited companies from the portfolio of the first fund that I mentioned. So started many years ago, basically doing transaction advisory, M&A, and it somehow traversed to fund management, to investing.
I was actually thinking about Wood and Company, which is the 4.5 billion total assets under management. You were founder there?
No. I was managing director in Bratislava office, in Slovak office for 2 or 3 years. I decided to leave, and we started Limrock, which was like the next station for me after that.
Yeah. I guess we can start with a question and have something like 1 minute, and if you really like, spend more time on it. I think, in my opinion, I don't know how you think about it, but the biggest mistake a startup can make is choosing the wrong people. And then the question becomes, well, who is the wrong person, and how does one identify the wrong person? I would say that it's a person who is not teachable, and teachable for me means somebody who will either not listen or not reconsider his opinion, not being open to change the opinion. So how do you think about this biggest mistake, and what is the wrong person?
Do you mean person like within the team or on the investor side?
It could be anything, employee, co-founder, investor. I think it's all about the people, right?
Well, every book says that team, that people are most important asset. What I learned from the investor point of view is that you only get to know people and really understand them once you invest, when you see how they handle your money or the money of the fund that you represent. For some people, it changes everything, and they change, and some people remain if they treat other people's money like their own money. That's one of the key conditions or key criteria or key things that I really like about people. I met people who told me that, well, if you invested, it would be your problem because it would be your money that is at risk, not my money. So I was happy that we didn't invest then.
They told you that in your face?
They told me because the deal fell apart, so there was no chance that we would invest anymore.
And is there a way to test for that?
No.
Okay. Until you give them money. And then you don't test for that.
I mean, I don't want to make stupid comparisons, but it's something like marriage or like a long-term commitment. You only get to know people when you are in bed with them.
It's worse than money. Thank you. First of all, let me welcome you, everybody here. It's an honor to have you here. And about the question, I think generally relationships is generally in life something that can fuck you up pretty well if you don't choose in any area of life, being it life partner, business partner, employees, and so on. So that's first. I don't think employees as such is such a big problem for startup. I think the founders and investors dynamics is the most important one, because that's the hardest to change, because that's worse than marriage, I would say, because money is involved and so on. And I agree it's difficult to know in advance, because from my opinion, from my experience, what we do, we are looking for this kind of people for 13 years, let's say, on the market, doing both consulting and startups. And I see it's very difficult to find a balance of ego and ability to listen, or let's say empathy. Because if you have one of these sides like wrong or too much, it's not going to work. If you have strong ego, yes, you can have somebody who will push strongly some idea through whatever problem. But if the idea is not completely correct and he will not listen to the customers, to the market, to people around him, he will crash, and it will be very painful for him and for the investor. And on the other side, if you have somebody who is able to listen, but if he doesn't have the firmness in him, in the ability to push through, he will keep changing and he will never accomplish anything. So I think for founders, I would be looking for a good combination of this stubbornness and ability to listen to other people, customers, and so on. That's like one. And this is already very difficult. I I would be looking for somebody who has a joy of discovering. I call it like standing at the edge of a fog and not knowing what's coming next and enjoying it. That's the process of being in a startup, And you have the employees behind you and everyone is coming and asking, so what's next? And you don't know anything, You just have the feeling it's going to be good because the problem is big and you somehow feel the technology somehow should help that. You have no idea maybe yet or some ideas. And they all ask, so what do we do next? And you have to be able to live with that, enjoy this process, enjoy this. And that's also very rare trait of founders. From my point of view, also a fourth thing would be it should be a nice person, like a good person. Like you can know it from going to the pub and drink beer together and talk, and we are going to spend a lot of time in the next 5 to 10 years together. So it's better be a good person. So like this, maybe from me.
Okay, I will comment on the founding team, because maybe to introduce myself again, I founded or developed a specific type or unique type of startup studio where I come up with business ideas and then I am looking for the right founding team for ideas. So pursuing the right founder traits is the major business for me. So I have something like an evaluation framework for finding the right founders. And so I am looking for, let's say, 10 traits and testing these traits. I think there is a nice overlap with what Peter said. What did you say? Something like a courage, curiosity, and also delivery. So not only talking about the topic, but also doing it. So I think this is the most crucial job, or the most crucial part when founding a new venture, because you can always pivot the idea, but it's really hard to change the founding team. And as Peter said, you will spend a lot of time in good times, bad times, with the same set of the founders. And you have to be nice, you have to be supportive, encouraging, engaging, etc. So, and it's really important to find a right mix of founders, not overlapping each other too much, but be more complementary. So, for example, I'm pursuing let's say, to have one business founder and one technical founder, for example, for a digital company. So it's always better to have a co-founder, because as everyone says, it's the most lonely job to be a founder. So it's always good to have a co-founder.
I think there was a research saying that the most successful startups have 3 and more co-founders, actually.
Okay, and there is a joke that one is not enough, and 3 is too much, and if there are two founders, so don't have the equity split like 50-50.
Yes, never.
So always should one of these founders have at least 1% more in the cap table. So there is a real leader, a real CEO. Yeah.
And maybe to throw some statistics and transition to the next question, you can tell me if this is also what you know about the reality of this world, but out of 2,000 startups, how many raise VC funding? Do you have a guess? Yeah, you know. So it's 1, right? So out of 2,000 startups, only 1.
From which phase? Starting which phase?
I think, well, that's a good question. I didn't dig deep. Thank you.
Sorry, I didn't want to catch you. I was just interested.
So okay, but there is I have a source. We can check. So and that means most of the people and out of 2,000 startups, 18 get angel funding, and a bit less than half get family and friends funding, which is about 50K. Now, another statistics says that one needs 4 or 5 full-time employees for about 2-3 years, and probably about 1 pivot, to reach product market fit. And only then one can go for the seed round, which is VC funding. And how do you see, Raman, startups, successful startups, how do they overcome this challenge?
Well, I think each one of us has their own experience, statistics, or book by which we go. What I see is that first years of startup is months, years. It's a chicken egg problem. There's always something missing. You are always chasing something, either people, either money, clients, product. I really can't see or say what's like if there isn't some there's no secret formula how you can overcome it, but the successful ones manage to persuade investors, persuade first clients, keep the good employees or co-founders, and make it to the next round.
In other words, maybe what do those that you invest in did differently to be at that stage? Because when you invest, this is the one out of the 2,000. And what do you think makes this one different from the 1,999?
Well, 50% I think is our selection, so that the selection must be somewhat right at the beginning. So we are not stupid going into everything or anything, and we need to be diligent and careful when doing the selection. In our case, I mean, you had the 2,000 statistics. I think that in the first year of the first fund, we looked at it was, I think, 315. And don't call it startups. It could be a startup, it could be an idea, it could be a pitch deck, it could be a student group out at the university hackathon, but 315 relatively teams, solid ideas, and we invested into 4 or 5. And 1 or 2 of them didn't make any money. So, I mean, it's difficult. But those who did, survive or even made successful exits. They happen to be in a good growing industry. The founder dynamics was very positive. The product was hot, but it was priced in our investment already, so we were able only to get as much,
Peter, you feel free to come back to this question or take the new question. I think that long-term relationships, we all know, are built only with trust, and trust is somewhat harder when the incentives are not aligned. And there is a difference for me personally between contractor and advisor, and you being from the agency side, when you sell your services, how do you build trust and how do you make sure that incentives are aligned in a sense that and I think incentives are better aligned when the other person is in pain when you're in pain. So how do you make sure that you build trust in a sense that you are in pain when the customer is in pain, and does it play any role in you winning deals?
Okay. First of all, let me return to the previous questions, because I think we forget about one dimension, and this is split of competencies between the founders in terms of one interesting pattern that keep appearing. You either can have 2 technical founders who are having the hammer and looking for the nails, and they seem like all is good from personal point. All what we discussed was good, but they are missing the business side of things, and vice versa. Sometimes you have like this business kind of magician, and he has completely no like content. He just knows where's the business, but no delivery capability at all. So this is kind of weird thing that is sometimes happening. To your question about trust, you know what we do. I started 2009, 2008 with innovations, and our first round was that we set up with 3 guys, with 2 other guys. We started 3 startups, and with one of them, I went to Silicon Valley. I was in the first round of Czech Accelerator going to Silicon Valley, when I met Michal Pěchouček and many other people who are still in the community. It was an eye-opening experience. And when we came back, we actually were always in the kind of startup side, but we didn't have any money and no great idea. So we started this kind of consulting business that where the idea was to bring human-centered design and lean startup and all these methodologies to let's say, big companies, which happened later. Let's say now it's like almost standard, but it's like 2018 it started, something like this. So 8 years I was selling something that, let's say, not many people understood. And it was really about trust. And I discovered that selling this kind of services, going to ČEZ or ČSOB, Česká spořitelna, Linet, Zentiva, MasterCard, was really about building a relationship with the board members, with investors, with people who decide who can take the risks to go with you to an adventure about, discovering new products where you have no clear result, So this is what we build here. And on this way, we learned how to sell it, how to change the risk, because it's very similar to the startup side. Last 4 years, let's say, we have about 50% of our revenue from investors and private investors and in startups. And it's very different. In fact, the competency is the same, what you do in the projects, more or less. Meaning helping them understand where is the market, how to format the product, finding the sales, let's say, arguments, and scaling the thing. It's the same, basically. It's just you have different borders. But we have to take the risk in terms of, let's say, kind of part of our fee needs to be somehow tied to the result.
How often does it happen that you really need this part to win trust and win the deal?
With startups, almost always. It's a good practice, I would say, almost. Because working for the startup for a regular consulting fee is very expensive for them. So if you want to keep it, you need to start on some lower level, but have some agreement, how much money you get in case something goes good, goes well. So this is how we do it. And in certain cases, we also take, let's say, percentage in the startup as a result. This can happen too, but very occasionally. Because there you have to hit, let's say, good constellation of a lot of factors for this to work well. So I think, in fact, it's very similar to what founders do towards investors, right? Because you have to take the risk and show the investor that you will take the money only when the startup is successful, not that you have a big wage every month and whatever happens.
Yeah. And so Peter.
It's the same, Peter.
Okay. Yes. Okay. So feel free to connect to any of those questions or to take the new one, which is people usually get the advice on fail fast, but there is a difference between making a lot of mistakes and making one big mistake that will put you out of business. And you, with your startup, if I can disclose the number, so you invested, can I?
Yeah, it's public.
You invested 1.5 million of your personal money as I understand, and you lost it after 1.5 years. And I would say it's, I don't know, from outside it seems like one big mistake and not a lot of small mistakes. How do you, what did you learn from losing the 1.5 million, and what do you do with this fail fast advice?
It was a little bit less, but it doesn't matter. But yeah,
Was it Czech or euro?
dollars.
Oh.
But
That's better.
That's still worse than Czech crown. So yeah, I wouldn't say it was a fail. So because I have to say that we had a really big bad luck, and it's a part of the journey. So sometimes you have a good luck and sometimes you have a bad luck. So I can't say that I can learn something from it because yeah, it was a really bad luck. Maybe just to describe it a little bit more, it was a 1-year-old startup, and we have already $2 million investment. It was almost done. Everything was done. We were 14 days before the deadline, and then the COVID came to Europe, so there was the complete lockdown, and all the investors, they stopped investments for, let's say, 5-6 months. So it was, yeah, so for a startup, it was the stop. And sorry?
What did you do?
So we tried.
What was the startup?
Yeah, okay. It was called blabu.com, and it was something like a Uberization of language education. So to improve your conversational skills, not to learn grammar, as for example you learn in Duolingo or so, but it was focused on speaking part. Yeah, but fail fast. I support fail fast, but you have to always learn something from it. So yeah, don't fail too much, so, because it hurts.
Would you spend your money in the same way if you would do it again, without knowing if you would be lucky or not lucky?
Yeah, definitely.
You would,
that was a good business, and it was it had a nice traction, but yeah, bad luck, as I said. Okay, so maybe back to the trust question. Maybe before I started the startup studio, I'm making the noise. Oh, yeah?
Not too much. Maybe.
Okay, the T-shirt is. Okay, so I will not move. Before starting the startup studio, I was more than 1 year in a VC fund, Kaya, here in Prague. I would say this is the most successful VC fund here in the Czech Republic, and I saw the same startup ecosystem from a completely different perspective. And what I learned, one thing I learned is about the trust. So also with the investor, you have to gain the trust, mutual trust. Investor has to see that you work with the money, as Roman described, and if you don't hide anything, you are completely honest, you are sharing successes, but also if something is not going well, you also share it with the investor, and you ask maybe for help, because you are partners, right, in one business. So this is really important. So don't underestimate it.
So next question. Yeah?
I can also reflect on the fail question that you had from our own experience, always experience of fund manager of the fund. It's much better if your founders tell you that there is a problem in advance, because they know there is a problem. It doesn't have to be like a critical or like complete failure problem, but a problem. You want to know it in advance. You always appreciate it when they tell you, and they always appreciate when you give them, when you show them your support, and they understand that you are not going to be mad if some money is lost because they told you, because it was not in bad faith, definitely not criminal. Something simply happened, and I think that, I mean, you have to lose money to make money, and of course, failing forever is not the formula for anybody because you don't want to be a failure all the time. But you need to fail to win. It's like, I mean, in hockey, in football, whenever. You have teams that are great, but they have good times and bad times.
And maybe following up on the trust, maybe making it a bit more specific, the question, from the statistics and now from my own experience, I know that for seed round, usually investors look for revenue, and this is the top metric, MRR in SaaS, and they look for 10K MRR for seed, or ideally above, but usually not below, and 100K for Series A MRR. Now, when one thinks about this one statistics, sales, it could be faked in some way. And what I mean by that is the startup could be driven by sales, so I can sell a shitty product and hire a lot of people who would do that and overpromise in a sense. Or the startup can be user-driven or product-driven or mission-driven, which might look not as impressive in the beginning, but maybe impressive in the long term. So how do you distinguish the fake metric, fake KPIs from real KPIs? Do you have any? Is there something more important than just revenue?
I think it's difficult to fake revenues or to fool an investor because one, you can always ask, unless something is incredibly hot, but you usually are diligent and you talk to clients, you see MRR, you see churn rates, you see a whole lot of metrics and statistics, and it would be, I think, a fail on our side or on the side of the fund if they don't see that something is not legitimate in the revenues or
maybe in
the client numbers.
In another way, is retention, what is the role of retention versus acquisition?
I mean, what's the end result? If the bottom line is working and the company is growing, then I guess you can have a variety of combinations of various metrics. So I would not be keen on. But I know it from our own experience. We have a company that is raising or doing M&A, and I mean, you hear from the fund, oh, we have this limit, we have that limit, and that must be less than 5%. This has to grow at least by 50%. Well, at the end, there is always a difference in those conditions. Like nobody goes by book and by Excel spreadsheet and you haven't met one criteria, you're out.
Maybe to interrupt you, it also depends on the stage of the company. So, for example, at the very beginning, you are focusing more on the acquisition, and then you have to turn the customers also to returning customers.
To repeat,
So these metrics are developing with the company.
Peter? We talked, I think I share with you the passion, let's say, for different methods on how to empower people to be creative and innovative, design thinking, lean startup methodology, etc. Why is it that humans need this kind of methods? Why do people suck at innovation? Why do they need you?
I don't think they need us. I think they just need somebody who will give them objective feedback. And let me go back maybe to the fail fast discussion, because as with any other rule taken to extreme, it starts to harm instead of doing good. And especially with the fail fast, I see many people using it as an excuse for incompetence. So please, you can fail fast doesn't mean to build a product and see if someone will buy it, because there are much easier and cheaper methods how to discover if there is actually a demand for the product before you build it, for example. Because every one of you probably know that the most repeated reason why startups fail is that they build product that nobody wants, actually. So, fail fast, it's actually a stupid idea to build faster product that nobody wants, It's much better to know some methods how to discover the demand before you build it. It can cost you much less money. And there are many examples like this. So this is about the fail fast. And I think it goes to the same question that you just given, why people need somebody else, because we are biased. We are all really biased. And it's very hard for even like very adult personalities to work with your own biases. If you have an idea, it's your baby. You don't want it to be killed. You want to show other people how great it is. And you can maybe, if you are a good salesman, you convince investor and he will give you a lot of money, and then the money goes to drain if there is not a good, transparent discussion about what are the facts of the business, what are the hypotheses. And it's sometimes very hard. Even, I do it for 13 years, and I said we are doing like a lot of projects through the years. And it still happens that I have some idea and I go there to one of my partners and tell them, hey, I have an idea, And I tell it, and he's like, yeah, that's a great idea, but did you think about this, And I'm like, yeah, that's an obvious question, isn't it? Okay, thank you very much, and the idea is not so great anymore. So it's not about, the methodology is to learn it will improve your chances to see the truth sooner. Yeah, but you still need to have your internal discipline to apply it, not to get yourself, let's say, overwhelmed by your greatness of your ideas. And that's why it's so much important, why I said in the beginning, we need somebody with a strong personality, but with ego in check. With somebody who doesn't think about himself, he's the biggest genius on earth, but somebody who is rather open to, questions, input. So I think if you look at design thinking, yes, it's in some part, it's like it's not a creativity methodology. It's in fact, it says, before you build something, go and have empathy with the users. And empathy means that you understand those people so well that if you ask them a question, you will know what they answer. And you will be right in, let's say, 80–90% of the cases. That's empathy. That you understand how they think, what they feel, how they behave. And with this, you can start creating ideas. Not before, it's different. So in fact, human-centered design or design thinking says basically one simple idea. Go and inspire yourself by reality, by real people who are going to use it, and build it. And then the second cycle is like prototype it. And it's the same, it's just another round of empathy, but this time you are using some kind of MVP to get yourself in check again, because the empathy itself is not sufficient. It doesn't give you willingness to pay or many other things that you need later for successful business.
Maybe a last question before we transition into Q&A, so think about your questions. Peter? Peter?
Doesn't matter. Peter.
Because I call you Peter. Okay. But
we are fine with all of that.
Yes.
Okay. So you at Beneto, you are taking 10% ownership when you co-found with other people the company.
Yes.
I'm a big fan of formulas when it comes to, in the early stage, to how do you come up, how to divide it. And I think the formula, in my opinion, should be time-based. That is how much time do I sacrifice and what could I earn with this time, my opportunity cost versus what you're offering me. And I wonder, how do you justify the 10% and what value you bring? Is it value-based, or how do you think about the split? How, if the new co-founder comes, because often that happens, you have two and then you need a third, or just a person who is kind of co-founder because he shares the risk, how do you do it yourself, and how do you advise then the founders to do it?
Okay. You describe a typical perspective of an agency to recalculate the time I will spend with the company in exchange for equity. So, and my perspective is the other way around, that so first of all, the concept of Budeto is that I create the business idea, validate it somehow. Sometimes I have a pre-interest from VCs to invest in it. And I will, when the company is founded, so I will stay hands-on with the company for another couple of years for free. No advisory fee is there. But the equity is calculated differently because I need to know that the end game value after the time that I will sell my share will have a certain amount, so certain value, specific value, and there will be a return of investment from the very beginning. So it's difficult, and when I come up with the idea, so I'm calculated somehow the future, how big the opportunity is and will be, how big stake I will have in the company, and then I can calculate the end game value. And also there is always a high risk that there will be nothing. So this is it. And there's another perspective that I know if I want to start an international company seeking investments from the investors abroad. So I know that the founders, original founders, can't be diluted too much. So the formula is somewhere that the founders shouldn't be diluted under the 50% by the Series A. So this is how it's calculated. So there is some typical there are some typical rounds and calculations. So it means that if there is the initial equity split 90-10, so that the original founders, they will be diluted somewhere to 50% by the Series A. So that's the calculation behind it, for example. It's not much, the 10% stake, but it also means that I can't start a low ambition business. So it means that there's a need of unicorn to be size of the business.
Can I offer a perspective on this? I saw several pretty strong fuck-ups with dealing with shares. One of the major ones being that the founders don't agree for a quite long time, and then all of them have in their heads some stupid ideas, and they basically, after 1 year of working together, split because they cannot agree on how to split the thing. And the more successful the thing is, the higher probability is they disagree. So it's really a stupid thing first. So I think it's very important to set up the formula in advance, in the beginning preferably, and in very specific terms. And I think there are like at least 3 categories of things that needs to be distinguished. One is work, which is measured in hours. And I think it works especially in the technical side, on the programmer side, with some limits, but it's kind of hard there to do it in a different way, especially when programmers are now so rare and expensive resource. Second is sales, and sales cannot be measured in hours. That's a stupid idea. Sales must be measured in the amount of revenue brought in, because I don't basically care if the guy brings 1 million euro that I need of sales next year, if he brings it in 1 hour of his work because he lifts up a phone and takes care of it, or if he's going to be running around for the whole year and brings half of it. Doesn't matter for me. The only thing that matters is the result, and that's the revenue. And for this revenue, he should have some pre-agreed amount of share. If he manages to do it, usually it's a time scale based. It's like this year, next year, and maybe 3-4 years until some certain threshold. Then he gets it. And if he doesn't achieve it somewhere, and the startup needs to find somebody else to replace him to take it there, then we still need to have the ability to take this portion of share, or maybe buy back this part and give it to the new guy. Or you will end up with a startup with a bus of dead passengers. You are driving it, and everybody is waiting what is going to happen. So that's technical, that's sales, and third is investment, or money to the cash, and that's obviously very simple. It's again not measured in hours, but in money and percentage to it. Sometimes I meet like R&D heavy startups where it's clear that it's not about, let's say, mechanical coding, but it's about maybe setting up some kind of new AI machine that will be able to forecast future, and no one ever did it so far. So in this case, I would also tend to say, if there is a technical guy who is saying, I am able to do that, and is not existing yet, I would tend to, let's say, give him share also based on the result. So find some black box measurement that this thing actually works, which he will set up, and tell him, okay, if you do it, you will have 20% of the startup. If not, I don't care how much time you spend on it, basically. You can have maybe some small fix as an employee, but it's worthless otherwise. So sorry for long talk, but I'm now full of emotions because I'm now solving with one startup and one investor already 6 months of very heavy discussions about startups, which has investment of 20 million Czech crowns at this moment, and big problems with this part.
Yeah, this mechanism is called vesting. And there can be regular vesting or reverse vesting. So it means, for example, you can have 20% equity share right now, but there is a reverse vesting. So, for example, if you quit after 1 year, so there will be, so you will leave just with the proportion you already vested. So, for example, you can decrease from 20% to 5 or so. And there is also, for example, the vesting, the regular vesting, you can set, for example, with 1 year cliff, so it's time-based, or there can be, as better described, project-based. So once you achieve this, so you will start vesting. So that this is the cliff. It was about my previous business, Blabu.com. It was I would say it went bankrupt during the COVID era, and due to the lack of financing. Yeah, because I set a stop loss for my investments, so it's always you always have to set a stop loss for. So it means it has to end somewhere, and yeah, it's hard to describe the situation in that time. It was really weird, and everyone was thinking that the world is ending. So, and I calculated the situation like if I invest, because I know that the pandemic will not end in like 14 days. So it will end maybe in 5 months. But I studied also the history of these pandemics, and always it comes in the second. There is a second round and maybe the third round. So I calculated this, and it was like I had to invest double the same amount to get it somewhere where maybe the COVID will end, and maybe the investors will get back to the investments, etc. So it's a risk, and I calculated the risk like, so there is a stop loss, and I will finish it. So it's a bad life, but yeah.
You don't spend the same amount like at the beginning, but you already.
Yeah, but it's there is a how can I describe it? So you have a company, you have 14 people inside of the company, so it's really heavy. So it was like cost 1 million Czech crowns monthly, so it consumes 1 million Czech crowns monthly without having any marketing cost. But you have to advertise the business, so it means at least 1 million more. So you can decrease the number of employees in the company, so shrink the company. Because you want to grow, and you can't grow without the team, etc. So you have to spend the money just to survive the COVID, and then maybe it will get back to the same situation as before. So you have never there is nothing sure that it will go this way. So what I wanted to say, after the COVID era, you want to go for the investment again. So the company can't be shrinked to like 3 people now, because it will go nowhere. So with 3 people after 1 year. So it's the probability that you will get the investment after the year with decreased costs, etc. So it's really, really low. So I decided to close the business. So maybe we can discuss it later, because it's so many attributes are in the thinking, and it wasn't easy, really. Long discussions with founders.
I would be curious as well about this, because like basically I understand the uncertainty at the beginning of the COVID, because nobody knew what's going to happen, but we saw many businesses, especially in collaboration space and like Zoom, or I don't know what was it, Hopin, that actually scaled rapidly during the COVID, and
yes.
They were able to raise a lot of money, like big money.
Mm-hmm.
So was it mostly about not knowing whether somebody was going to invest, or people?
But these companies were in a completely different stage.
Okay.
I had a 1-year-old company, and if you have a giant like a Zoom, you will always find investors. But I was at the very beginning, and there were 4 investors. They wanted to invest, and after the COVID lockdown, there was no one. So it was really weird, hard to describe.
Yep.
It's an open question, whoever feels comfortable, because it resonates with many of the things you said. It resonates with how to choose people and stumble in the dark, like Peter said, like there's the fog and you make decisions, something works, something don't. But in many senses in startups, you have a line of decisions to make. And in those decisions, you can make a good decision and a bad decision, but there is a lot of luck and just pure coincidence with things. How do you develop the sense to differ between good decisions and just pure luck, without the ability to make, let's say, A/B testing, because you can't do an A/B testing over hiring someone, or going into a new product, but in general way, like, do I invest in it or not? So how do you develop this sense of this was a bad decision, but I had luck, against this was a very good decision, it just didn't work?
I should grab the question.
It's an open one, whoever feels most.
Okay, I will be very quick. So you never know if it's a matter of luck or a good decision, but you have to make decisions very fast. So this is really important. Don't slow down making the process of making the decision, because, for example, the team is waiting, and the team has to know whether to go left or right. So this is really important to make decisions very fast, and always I always say that was a good luck. And you have to develop the inner sense of, to feel the decision. Sometimes you can't describe why you make the decision, exact this decision, but this is the matter of the leadership that the company, your colleagues have to believe in you, and that you make the decision. This is the right decision. That's it.
This is very valuable. What Marcel said. My 2 cents would be, well, with the benefit of hindsight, everybody knows what was a good decision and a bad decision, but you never know in advance. When we are making decisions or our teams are making decisions, I tend to see that it always works better if you understand why you are making a decision. If the decision is made just as a hope, I'm saying hope is not a strategy. You can make a relatively poor decision, but if it's based on some understanding of something, then it's a decision. But if it's just a hope, well, it's a hope. It happens, it does not happen. It helps if you document your decisions. Maybe mentally, it doesn't have to be like a paperwork or in the system, but make a mental note or an institutional memory if it's a team already, why you made decision and what were 2, 3 most important things that made you make this decision. And then you learn on your past decisions.
Yeah, I forgot. I always write down the thinking about the result.
I sometimes make notes, really, like in my current notebook, and something that only I understand what it means. But
yeah, you collect all inputs, and then there is a result. Yeah.
Actually, I was just thinking if I answer also the previous question, and this is exactly the part. I think it's important for the good decisions to actually start with a good positioning of yourself, and it starts with several things. Aiming at a big problem that people actually care about to solve, where you already see that existing solutions are not sufficient. And you have some kind of competence that is relevant to solving the insufficiency on the market. And this you can have, I think putting yourself into a point where you try to bring a product, half-working product, towards a problem that is, very weak on the market, and you already have a team of 10 people working for you with a 2 million of running cost, you are already in a really bad position, to whatever decision you are going to make, It's going to be very hard. So what I would say, take your time in the beginning. Bootstrap, the beginning, not later, it's not like forever. But, until you really understand the market, where you are going, understand what is your position towards the customers, find ways how to clever test it. In B2B, you can easily go to meet whoever you are selling to, chief of sales, talk to him about the problem, and you will very easily get to a moment that the guy will tell you, it's such a big problem, this impact, that impact, I would need to solve it, And you ask such a good questions, do you have something to help me with, And you can easily sell him a project on this. In B2B, it's very easy, like testing propositions. Sell the projects, You will sell him man days, man hours, something. You even make money, and it's fine. And you do 2, 3 projects, and you start to understand the pattern, how the product should be working. So that's B2B. That's the best, The hard part is getting to the decision makers. If you need to go to board, it's difficult. But if you aim like mid-level, easy, no problem. So this is for B2B. For B2C, it's actually more difficult and more simple at the same time. More simple in the way that testing for the problem is easy. We had a project where we were working on new loans. Thank you. New loans. And there was the idea that we could give people loans for traveling, for example, for buying the 1-year card in Prague. And we had like 5 concepts on different ways of help people traveling and giving them loans and so on. And we had in one day, we had 10 people per 30 minutes discussing with them, how they live and, how they finance various things in their lives. And we showed them these 5 concepts. And out of those 10 people, 5 of them call us within the next 10 days asking when this loan for the yearly ticket in Prague will be available. The product didn't exist. It was just a card with 3 letters on it. It took us like 2 weeks to put this together. So you can have very, very quick and simple and very strong feeling if there is a problem that people care about solving. And then, of course, later about all the landing pages stuff and this kind of thing. But I think it's sometimes overused. Putting together a landing page is not the simplest thing to do. And it has a big problem because if people don't use it, you don't know why. So first of all, you need to know about the problem, and second, it's good to try to test selling the product in person, face to face. In B2C, it's simple in this way because you can go to the street and catch the people on the street and talk to them and try to give them leaflets. See if they give you email in exchange for something or even money or whatever, you can test it. It's just about the creativity. Sometimes, very often, the more difficult thing than having the idea about startup is finding ways how to create good testing of the idea. It's much more creativity needed. Sometimes it's difficult, requires a lot of discussion to set it up correctly, but it's always worth it. Waiting lists, landing pages, you know the stuff, it's everywhere, written on all these startup things. It's all right, everything is good, much better than doing the product and then waiting if it's going to work.
So you shouldn't start a business before you find the right product and the right customer. Or you see that it's working somehow, and you will, for example, just find the right pricing. Yeah, for example, you do this research, and after that you launch some fake door campaigns, fake e-shop, etc. And you are just testing the right pricing for the product. But you already know the customer and the product. What about the timing? You never know.
Well, you can see it, if you do the text correctly, you can just see it. Because some people say even another typical question could be, are there any needs that the customer is not aware of, and we will educate him? That's a mistake, It will cost you a lot of money and probably will not achieve it. We are looking only, regardless if it's B2B, B2C, we are looking only, are there people who currently have this problem top of their mind and really want to solve it and want to pay for the solution? If not, they are not there, and I don't care if they are going to be there in 1 year. It's not so important, because in 1 year is too far in advance for the startup. So, and we can test that very, very simply. Even in B2B, selling cold emails, which seems like a stupid idea, because no one answers in B2B cold emails, right, from foreign people. Actually, if the proposition is strong, they will answer. So this is already, we just tested it now with one proposition, and I was very surprised. We achieved like 30% response rate on one B2B campaign that we sold, like testing 20 emails towards HR managers for some AI stuff. It doesn't matter, But it was just a good idea, and they just, yeah, please call, we want to meet, And we were very surprised. So there are clever ways how to know it immediately. Who are the correct customers, to answer your questions?
So maybe 1 or 2 questions more.
Maybe just about the timing. So it's a standard situation that sometimes you are too early. For example, you are tech savvy really, and you are before your customers, so they feel it. For example, in my startup Blabu, so that was the Uberization of language education. If I was 10 years earlier on the market, so it wouldn't succeed, because people were not used to use Uber-like services. So the timing is crucial, and yeah, if it doesn't work, so you can try it later. But if you have still energy for it. I think it depends really investor by investor, because investors are human beings. Somebody will believe in your idea more and will not need the exact numbers. Someone will be more like spreadsheet guy and will want to see the numbers, so exact numbers that you already have customers supporting your idea, etc. So it really depends, and but usually investors are betting on the face of the founder if they believe in you that you can really make it big. So it's not it's not an answer.
Some milestones or
it really depends, really.
Well,
Yeah.
there are general rules to increase the probability. Like if you have revenue, you have much bigger probability if you don't. But also the relationship plays a big part. I see, I call them hobby investors, let's say. It's kind of special kind of guys who have a lot of money and just invest into 1, 2, 3 startups. And they will give you money, you know, if they like you and, you know, care about maybe the problem that you want to solve. I saw people who like thrown away like 5 million check like for development of mobile app that is, you know, for nobody because they like the software company that brought the idea to them. And so, you know, so it's, but of course, the more professional investor you go to, the more rigid, let's say, the rules will be. You can, they are described everywhere, basically, you know. But I would say also another factor is if you don't have revenue, you will have to give up much bigger portion of the company. If you have revenue, I have now a friend who went through 10 or 15 VCs with quite big startup for a, let's say, Series A seed kind of somewhere. And he told me one experience that it was everything like, yeah, okay, let's meet. But once he told them he is break even, that he can pay the monthly cost with whatever is coming from customers, he said the energy in the room totally changed at this moment, like positive towards very positive difference. So this is one.
Well, these days investors really like not growth only, but also profitability and sustainability.
Yeah, you should definitely pursue some recommendation from the founders being invested from the same investor before. For example, also you will see or you will feel it after the discussions with the investors if the investor can really bring some additional value. It's also matter if you are seeking some business advice or product advice. And definitely I would ask the investors if they can introduce you in follow-on rounds, if they can introduce you to some bigger investors abroad, etc. So they will open the door for you and will help you in the follow-on rounds.
What is helpful, I think, and it's something that we tend to do, is that you spend several, maybe many months with teams before you invest, and you want to show them what you know and what you can do. And it differs from time to time, from team to team. Somebody likes HR hiring experience. You can help them somehow. You can point them. You can actually go show them candidates. You can go to interviews with them. Even help them sort of pre-select. On the financing side, you can show them, you can bring co-investors, you can talk to the bank if they are at that stage. And if you give them that value and that feeling that you are a normal person, normal investor who knows their stuff, who can help, then I think it's building the relationship. So founders shouldn't be looking for investors who say, well, I can double your revenues because I know somebody. Well, no, you have to double your revenues. You have to sell, but they can help you with the problems.
Last question, if anybody wants. No? Okay, so I guess we transition to the last part, which is just saying thank you, and thank you all for coming. Thank you, Peter, for hosting us.
Thank you for coming.
Yeah, it's great. And,
it was a pleasure.
Yeah, and thank you so much, Andrea, for planning, marketing. Without you, this event would not be possible. So maybe a big applause for Andrea. And I also like to say thanks to our sponsor, Startup Yard. Andrea is involved, of course, in 22minds, but also in Startup Yard. Do you want to say something about Startup Yard? No. Okay. I guess I also like to share a bit about our startup, Ingura. Well, 22minds is my hobby project, but I'm a founder of Ingura. And who is in B2B sales or is familiar with B2B sales? Okay, great. So I guess in the last 4 years, we interviewed many thousands of B2B salespeople, or senior B2B salespeople, and we asked them a simple question, that is, what do they hate most? And the answer is cold outreach. Why is that? It's because cold outreach means rejections, and it means waste of time. Now at Ingura, we eliminate cold outreach. How do we do that? Usually cold outreach starts with building a list on LinkedIn, because this is where you find people. And you can find them by industry, company, title, location, etc. When you have built such a list, thousands of targets, then you reach out in cold. So with Ingura, you can insert these targets, the search you have made, and Ingura will analyze them. And we will predict who are the top 10 people who you should not reach out in cold. Why not? Because you have real mutual connections, people that trust you and people that know the target. And so you can get a warm introduction or just mention this relationship, boosting your credibility. And why does it matter? Because when salespeople, B2B salespeople, when you look up in your CRM, you will often discover that leads coming from your network, so from introductions, from partners, customers, etc., they convert that probability of something like 10%, 20%, which is huge. And I guess you can testify to that, Peter. And when you look at cold outreach, typically, unless you figured it out, it's 0.01%. So the difference is like 300 times, and this is what we boost for salespeople. We are still in the early stage. We have a free trial. We offer a free trial, so I'm looking for feedback. So if you want to try it, reach out to me. I guess we're also looking for co-founders in development, in sales, and in design. And of course, we're open to investment. With the experience, maybe to connect Ingura to 22minds, with this experience, we have now 14 angels. In a bit less than 4 years, we have 14 angels. And Startup Yard is one of our investors. And it's difficult. It was very difficult to get money. And it is continuously difficult until you have 10K MRR. This is why I asked this question. And what I figured out, what works, is getting people, smart people, who can help you to refine your plan. Because of the biases, you need them. And you need, as Peter said, somebody to push you back. And when your plan is better validated, you can present this plan to your co-founders. And it's easier to find a co-founder, which is investment in time, after you have some advisors. And so with this idea, 22minds was born as a refined project. So events are our, you can think of that as marketing, but we match advisors with startups. And so if you are having hard time fundraising, and it's very difficult, it's like one of 2,000 gets VC funding, it's probably not you. So maybe you, but probably not. Statistics say it's not you. So what can you do? You can get advisors first. And so if you want to consider that, again, talk to me or Andrea. And we are, with 22minds, we are open to sponsorships. We are open to partnerships. Also looking for co-founders for 22minds. And I guess the next event is on 7th of November. It will be at Outreach. I'm not sure if they're a unicorn already, but they're quite successful. And the topic is surviving the startup storm. It's about the product market fit, whatever. I will not read it. So it's a free event. This one was paid, but the next one is free. The quality is not decreasing, but yeah, I guess we're experimenting with pricing or not. So feel free to share feedback. And there are QR codes. We do communication through WhatsApp and Telegram. If you're not part of our groups, please join. And also there is a QR code for the next event, so please subscribe. The places are limited. We will do a photo. I don't know if you want to have some closing remarks before we make a photo.
No, just thank you.
Yeah, thank you for your question.
Yeah, thank you. And thank you, Slava, for all the effort you take to organize all this.
Yeah, for organizing.
Yeah, thank you.